Hello and welcome to Virtual Investor Conferences. My name is Phil Carlson, and on behalf of KCSA Strategic Communications, as well as our co-host OTC Markets Group, we're very pleased you have joined us for our next live presentation from Vext Science. Before I introduce our speaker, a few points to note. Please submit your questions in the questions box to the left of the slides. If you're interested in scheduling a meeting with Vext Science, please click on the Meetings tab found on the left navigation bar. You will be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I am very pleased to welcome Eric Offenberger, CEO and COO of Vext Science, which trades on the OTCQX.
Thank you, Phil. I am pleased to be joining the conference and wanted to walk through the investor information of Vext Science. I'm going to skip the second slide and go right to slide 3. So one of the things we want to talk about Vext and that we're really highlight is that we've been in the cannabis space for quite a while. We started in 2013 and really fully got running in 2014. Went out to the public sector in 2019. So we've been in the space for quite a while. We've got an established footprint in Arizona where we operate in a good market that we anticipate from everything to continue to grow and continue to see major improvement in the overall consumption of the market, and the overall population of Arizona continues to expand and grow. We've seen the recent announcement where we're going into Ohio, and we've been able to increase the footprint in Ohio and be vertical in Ohio. We anticipate that'll be all through Q2 2023. We'll have the majority of that accomplished and finished by the end of the year. We have opportunities for M&A and an ability to be a consolidation partner of choice. We feel like our operations are lent to that. We've got a proven management team. As I mentioned, we've been in the space for a while. We have quite a bit of experience and knowledge that's within the company, and we feel that way. We have good cash flow. We really have always focused on the operation from the performance and the cash flow. And we have a good alignment with the officers and directors of the company, owning about 28.3% of the company. This next slide is a graph of the states where we operate in. The primary states are Arizona and Ohio. In those states, we are vertical and we own those as far as 100%. We have some JVs that I really won't hit upon in the presentation. We can talk about those later, but they're more how we identified markets that we thought made sense to minimize our capital approach, and that's how we started out in Ohio before we acquired the balance of it. This is looking at the Arizona footprint, and we still feel really strong about the Arizona market. We like it. We have 2 dispensaries that operate, 24,000 foot currently of indoor cultivation, and we have a manufacturing facility. The revenue in the third quarter was $7.7 million, and this is all Arizona revenue, primarily. Adjusted gross margin of 60%. You see the adjusted EBITDA at 3.3, which is a 43%. You look at the cash flow from operations, 3.1 operating cash flow, 11.2 margin. As I talked about, the overview in the box you see on the lower left, is we operate the Vaping brand, which is our wholesale brand. It does very well in the marketplace. As Arizona's gone, there's been more wholesale business, more brands coming in. But it still seems to be holding its own. We've operated profitably since 2016. The next slide looks at our retail distribution centers. We have 2 retail stores in Phoenix. One of them's located, the original one's located in an urban setting. Very good demographic, nice customer base. We've been there since 2013, 2014. It's got ample parking. and we have ability to expand that footprint if the economies lend itself to that. The other dispensary we have had operating in this facility since July of 2020. It's a nice facility. We have the ability to expand it also, and it has ample parking spaces, which is what we think is critical for successful dispensary operation, is to be able to get the customers ample parking, so we don't have that issue. The next slide, we talk a little bit about the brand and some of the stuff we've been doing with the brand. We're in multiple dispensaries in the state in addition to our own. We have a full line of products. We have dessert style toppings, whether it's the edible side, the concentrate side, beverages, it's full line under the Bacon brand. Anything except for flour. We really don't do a lot of distribution of flour, like very small, other than some infused pre-rolls that we do under the Bacon brand. But for the most part, the flour we do is consumed in our own stores. Targeted expansion on the cultivation, and this is important, especially when you're looking at the Arizona market. So what we're representing here is we have been very smart in how we did the growth of our cultivation, because as Arizona went to adult use, you saw a lot of people expanding their cultivation footprint. We've never been in the wholesale market in Arizona because we feel like it's an oversupply situation. That's why you've seen some of our hurts and pricing pressure. This way we maintain our margin. We consume the flower that we grow in our stores, which gives us better margin protection. And that's why we like the vertical state like Arizona or Ohio with the limited license. So we're currently at 24,000. You might have seen the press release today that we have a certificate of occupancy for cultivation expansion in Eloy here that we've been working on. We only built out half of that facility because we didn't want to have the additional asset cost sitting there with a declining market or pressure on the flower market. So we've got the room to grow, but we also have the room planted to what we need. This is the Ohio. This will close. It's closed. We own it, but from a title standpoint of the state recognizing us, we're in the process of getting all of the 100% ownership. We've been operating in the state as a JV, so we're going through the process of getting all of it. So what happens in Ohio is we have an operating dispensary in Columbus that we're submitting to the board to change the ownership on that. It's operated for over the year period. And then we have a dispensary that we were given operation of January 2nd, and that's now labeled Herbal Wellness Center, but it's in Jackson, Ohio. The cultivation, you might have seen that announcement earlier this week. We've had our first harvest there. It's a tier 1. It's got 25,000 feet based upon the statute. After operating for a year, you can apply to go to 20, an additional 25 to go to 50, and then we have a manufacturing. The manufacturing and cultivation are located in the same building. That building has capacity to up to 100,000 feet of cultivation. So we feel like it's really ideal for the growth that we anticipate in Ohio. You remember Ohio's a population of roughly 12 million, does not have a recreational program yet. It's capped its cultivation right now in the tier 1s at 20. So we think it's very favorable and that market has a lot of upward potential for us. Excuse me. This is how the Ohio acquisition worked. So we acquired it in December 2022 from our partners. We bought the remaining balances of it, and this was the transaction cost. It was about $12.5 million with $11 million paid in cash or vendor carryback promissory notes. And then we acquired Buckeye Botanicals for $6.9. Now, Buckeye Botanicals has been operating in the space for a couple of years, so it's got an existing customer base. We feel like it's got room for upside potential, and it was accretive to the shareholders of Vext. This is our limited license state and what we like to do, and this is what our strategy's been for where we want to be fully owned, or we want to own fully versus JV. And the JVs were to give us an indication of whether that market made sense. We like the limited license states, and you look at Arizona, We might have to tweak these numbers a little bit, but it's a general ballpark of where they were at in the last time we went through all this. But we like the states that have a limited license on the retail side. We like the retail front. And then we want to be able to match our manufacturing and our cultivation so that we're not into an oversupply situation. So if you look at Ohio, you have very limited number of dispensaries. That's why we think that the wholesale market will be supported there more so than other markets that are more mature. It's still developing out there, so the wholesale has run on it, and that's why the cultivation made sense to be able to build a bigger cultivation than what we would consume normally through 2 stores. And we have the room to grow additional doors in Ohio because we're not at the cap, versus a state like Colorado that's more mature and has the unlimited license. You see the number of dispensaries per 100,000. This is a clear path for our further growth in Arizona. We still think we can extend the footprint of our current dispensaries based upon the new rules. That means that the population of Arizona is growing and the customer base in the city of Phoenix is growing. One of our dispensaries is located close to where the Taiwanese semiconductor manufacturing is going in Arizona, which is a $50 billion project around that area, and it'll bring in more housing and more population. The cultivation's 24,000 will go to 41. We probably won't utilize the whole 41 capacity as we look at rooms that make more sense, that need some renovation from the older time and taking advantage of the new build. But we also then can expand to 58,000 as the market grows. So we, again, have the ability to expand, not the necessity of it's already been built out where we're going to have to feed a fixed cost. Manufacturing, we have about 9,000, and we have another 6,000 feet on the property that we can expand into, that we're working with the city to zone, so it's under the existing licensing. This is the thought process that we keep thinking, that as we continue to develop this platform and that we're going to have more consolidation opportunities, more M&A opportunities based upon the cash flow that we're generating, and trying to identify additional operators that are similar to our thought process, or operators that are wanting to sell, looking for it. So we run a lean operation. We don't have a lot of overhead. Our G&A, our expenses as a percentage of sales are low within the industry and have operated efficiently. And I think that's really what's always generated our net profit and our cash flow, is just paying attention to those expenses. This is the quarterly financial performance. And what I really like to focus on here and look at is, even though the revenue's down, year over years, it's a little bit off, but it's off from inflationary pressure, not customer count. So we're not immune to anything that the rest of the industry hasn't experienced, or the rest of the economy on consumers, is they have less disposable income and they're getting more, more choices. In cannabis, obviously, you don't have the credit card function, so that puts a little bit of pressure on your ability to do that. But what I wanted to point out is that the adjusted EBITDAs have been going up or staying consistent or flat, so that even in a declining pressure on the consumer, we're able to use the model with producing the product ourselves is more to keep the margins at where we want them to be. And since we don't have to enter the wholesale market for the flower, which has the most pressure, we haven't seen the margin erosion. So this is our share structure, the way it exists today. We have about 180,000, as we talked about in the earlier slide. 28% of that is internal with management and directors. We feel that's a good mix. That makes it align. This is the slide you can read about the management background. I've always been in manufacturing and distribution my whole career, so I'm very familiar with this commodity structure and how those work. And the management team, has been able to adapt well. This is our board of directors. You'll notice that we have a diversity of the board of directors. We have board of advisors that have patent experience and pharmaceutical experience. And we do have a provisional patent with ASU right now on the cannabinoids. So I think some of you have seen that too. And again, I just want to go over to close it up, is that we have the established footprint in Arizona, continues to operate profitably, generates cash flow for us. We're bringing up Ohio. We have opportunities for expansion as it makes sense. But the big thing is we've spent and have funded this capital growth and have it funded. We have attractive debt for what we did, sub 10. So we feel like that's going to allow us with these new assets to really start throwing off cash as they start to come in and then pay down some of that debt structure. With that, I'm going to open it up to questions. The first question I have is, following your experience in the Arizona and now Ohio model, which state do you think could be the next big cannabis market in the U.S.? Right now, given everything that I've seen, Ohio, I think, is going to be the best state in the country. They've got their structure right. They've got a good structure. They've got a good population. They haven't gone to adult use yet, so they'll have that upside. They've kept the cultivation capped. So every state that has this cultivation growth, it's like any agricultural product, it gets overproduced and the supply outseeds demand. So Ohio's done a good job on that, and they keep it. When I'm looking at states that are looking at trying to do cannabis laws or medical cannabis laws, I think Kentucky's attractive for us because we already have a footprint there with the joint venture. Obviously, I like North Carolina, South Carolina. So that's kind of what we see. But I think Ohio's going to end up being a great return on assets for an investor standpoint. Next question I have, are you targeting operations in any additional states, and what are your catalysts for growth in 2023? That's a good question. I mean, I think if you look at the states, Illinois is attractive. They do a good job there. They've done stuff on the cultivation. I'm a little bit trying to understand what they're doing on the social equity side on the retail front, if that'll overpopulate their retail footprints. But right now we're focused on Ohio, Arizona execution and cash flow. Why we start to get that going, and then structure our debt better to be able to reload when it becomes right. Because we own our property, so that's what we've done, is always own the property. I always tell people, the strategy of Vext, and we talk about it in the slide deck of, better opportunities for people to consolidate and grow with us and stuff like that. We built the company with the philosophy that if you build a company that somebody would want to buy, you have a company that somebody would want to go join. So we made it so that we would have optionality in the company to be able to do growth. We didn't want to hamstring it with anything bad on the balance sheet. We didn't want to overextend ourselves on a debt or end up with debt that was hard to service. And we wanted to stay focused on the states that were vertical and lent us the best opportunity to make a return. Next question I have is, any plans for the EU markets? Not at this point in time. We've looked at it. We looked at it more from the CBD standpoint of anything. Looking at it from the cannabis structure, I think it'd be a distraction right now while we're trying to do Ohio. And as I said, we've got a small management team. We have to look at operations that, when we look at it, expansion in that, we look at two things. We don't really want to get in the fixer-upper business. We want companies that either have great staffs or great balance sheets. It'd be ideal if they have both, but we have to have personnel and we have to get good operators. And if there's a company that's balance sheet's a little bit off that we can help with in that, but it's got good operations, we're okay with that. If it's got both or bad, then it's not for us. Next question. It's very interesting that Vext has been profitable since 2016. We don't see a lot of that within the cannabis industry. What does Vext do differently to achieve this through varied economic environments? I'd like to say that we're smarter than other people, but it's probably we got lucky on a lot of stuff. And necessity is always the thing that drives you, right? So we weren't rich and we didn't have a whole lot of capital. I'm conservative by nature. I don't like to hit home runs. I like to hit singles and doubles and move the ball, move the runner. So we've always done it out of necessity. Up until going public, we always did everything as we could fund it. So it was bootstrapped. So we're used to eating ramen noodles at times and maybe getting hamburgers and hot dogs occasionally. And it's very rare that we can afford steak the way we look at the P&L. So that's kind of the philosophy of the company, and everybody's adopted it, and everybody works that way. This next one's challenging. Okay, so any thoughts on Ohio's DeWine stand on adult use? Yeah, I think the wine stand is, he'll get, at some point in time, it'll go to the voters and stuff. The legislation pending now is interesting, and that's what prevents us from filing for Columbus change of ownership right now, because it's trying to move out of pharmacy into commerce. So we're trying to wait and see how that goes so that we don't end up with a double filing, that we end up between agencies. But I think he will change. I don't know what he's going to do politically. I think he's getting towards the end of his career. So 2024 is when I anticipate it to, see the pressure, see it do something. I think it'll be through a voter issue. When do you release Q4 financials? I think we'll announce that pretty soon when we're going to announce those. Obviously it'll be next month in March. So that's the answer to that. Milestones for 2023. I think the first milestone we hit, and we put it out the other day, we did the first harvest. So now that operation's running in Ohio, I think it'll hit full production by June where it's cycling. That market stays really solid on wholesale, so then you start generating cash and you start paying down some of the debt to get yourself into a position to reload. I think that's the biggest milestone for us right now in front of us. Eloy's the other one. We'll start planting in Eloy, and I'm guessing by the end of the second quarter, we'll have some plants down there and start seeing what happens, because that facility is going to be similar to Ohio, and we're getting really extremely excited about the operation in Ohio and what it's doing. The new equipment, the rooms are more modern than what we had originally, because we built the original cultivation in 2013. So early 2014, we've been modernizing it as we go over the years, but it's not, brand new state-of-the-art equipment. It's got a little wear on it, so we're seeing that good. What is your capital position in your 2023 initiatives funded? Yeah, 2023 is funded. We moved in 2023, probably at the end of the first quarter or early into the second quarter, where it's strictly maintenance type of capital. So we don't anticipate that's going to be a big burn, a big need, because all the equipment's new. Most of it still has manufacturer warranties. So we don't see really a big capital need. We are going to work on a lot of growth within the existing facilities, because we're just now bringing them up. So I think they're going to go with their growth and the efficiency, and we continue to see that. Is Vext going to distribute the Vapin brand in Ohio post-acquisition close? Will you be looking at partnerships with any local brands? Okay, so Vapin's brand has been in Ohio since 2020, and it's been in 95% of the dispensaries. So yes, we do look at a lot of white label opportunities or contract manufacturing, because we are, the guys are experienced, the ladies and that are experienced with that. And the team really is good at manufacturing, operations, distribution. So yeah, we take on those opportunities. We've been doing those in Arizona. We find them to be attractive. From my background in the steel service center and prior life, I liked doing tolling and contract work. I think it really utilizes your assets and utilizes your team, and it spreads your fixed costs better so that you're operating more on a variable side. We like that, especially in a tough economy. I'd like to have as much in the variable side as I can versus fixed, obviously, and we do that. So, our rallying cry is always, cost control and price discipline. Watch your price, watch your margins, watch your costs. We've been doing that even prior to the inflation setting in the overall economy. Well, with that, unless there's any further questions, I'd like to thank everybody. You can get as much information as you want from VextScience.com. All of our contact information is on there. The deck that I went through is up there if anybody would like to get that. I have one last question. What do you see as Vext's biggest obstacle to your M&A initiatives? It's like everybody else in the space or everybody else in the economy is, sources of capital and what you're going to do. We don't want to do anything on the equity side that would be diluted to the existing shareholders without it being accretive. We trade at a low multiple based upon, what the analysts are saying and, what historically we've done. But everybody in the space has that. So we really need to focus on getting that debt down because of the way we've structured the company. We have advantages of being able to finance. And that's what we did on the Ohio. So we used the existing assets to finance off at attractive rates that didn't really put a crimp on the cash flow ability or the company's ability to do operations. So we really never want to, we don't want to have the company operating on a shoestring. So we feel good about that. Again, thank you very much for joining us. And with that,